The first adjustment, net realizable value of inventory, is the potential selling price of inventory. Compare this value to the cost price of inventory, which is found in the trial balance. The cost price is $39,000, while the predicted potential selling price of the goods is lower, $38,500. In accordance with prudence concept, business must recognize this potential loss on the inventory. It is called impairment loss on inventory. This is equal to the cost price minus of net realizable value, giving you a potential loss of $500. This item, impairment loss on inventory, the impairment loss on inventory is an E item found in the income statement. You will also have to change the cost price of inventory to its lower value by minusing off impairment loss to give you a new inventory value, $38,500, which is written in the balance sheet under current asset. Item number 2 tells us that business needs to record goods sold on credit to trade receivable. Its selling price was not recorded. The cost price was already recorded, so you need not change the cost of sales and the inventory value. Just change two figures because of the double entry, debit trade receivable, as you just discovered that a customer owes you $3,500 since you sold goods to him on credit. Credit sales revenue to record another sales revenue as you just sold goods worth $3,500. So go up to your trial balance, go and increase your sales revenue by $3,500, increase it, and go to trade receivable and indicate that another customer owes you $3,500. Adjustment number 3 tells us that a customer cannot pay you, so you are asked to write off her debt. Since she cannot pay you at all, you need to decrease trade receivables when you write off the debt of $750. At the same time, you will also have to change the allowance figure because of its double entry, debit allowance for impairment of trade receivables. Go up to trade receivables again, and since the customer cannot pay you $750, you will minus off $750 from trade receivables. Go to allowance. A provision for allowance of impairment of trade receivable had already been made last year, and since this customer cannot pay you, you will also minus off $750.